Hey guys, what does the future hold for NIO stock following its latest earnings report? In this analysis, we will delve into some critical numbers, examine key changes on the horizon, and evaluate whether the stock remains bullish. However, there are some concerns to address as well. To provide a clear summary upfront, Q2 appears promising, but Q1 is expected to be quite poor. By the end of the year, we are likely to see a significant turnaround, finishing higher than current levels. However, in the middle of the year, a potential dip lower than current levels is highly probable. Now, let's examine some of the most alarming statistics and financial metrics. Comparing NIO to its industry peers paints a concerning picture. One of the most glaring issues is selling, general, and administrative SG&A expenses. NIO's SG&A costs amounted to 15.7 billion RMB, accounting for approximately 24% of its revenue, an extremely high figure. In contrast, XPeng's SG&A costs were significantly lower at 6.8 billion RMB, representing just 16.8% of its revenue. Meanwhile, Li Auto's SG&A costs stood at 12.2 billion RMB, making up only 8.4% of its revenue. Clearly, NIO is experiencing the highest SG&A expense ratio among its competitors. When these costs are broken down per vehicle sold, the issue becomes even more pronounced. Based on the total number of cars sold in 2024, Li Auto's SG&A cost per vehicle is 24,370 RMB, XPeng's is 36,150 RMB, and NIO's is an astronomical 70,920 RMB per car. This figure is nearly double that of XPeng, underscoring the inefficiency of NIO's cost structure. NIO's average selling price in 2024 is approximately 260,400 RMB per vehicle. Factoring in a vehicle margin of 12.3%, each unit sold yields a gross profit of around 30,300 RMB. However, with SG&A expenses at 7,920 RMB per vehicle, NIO is operating at a substantial loss per unit. This explains why, despite record high revenue, the company continues to report record losses. The more vehicles NIO sells, the greater its losses grow, primarily due to excessive SG&A costs. The company is overspending on sales representatives, marketing, storefront leases, and other operational expenditures. These areas require urgent cost-cutting measures. The happiest individuals in this scenario appear to be NIO's sales representatives, who earn commissions ranging from 2K to 4K RMB per car sold. Even during inventory clearance sales, these commissions remain unchanged. In 2023, bonuses were exceptionally high, further exacerbating the problem. Sales reps are raking in considerable earnings, but these incentives need to be adjusted, especially when the company is providing discounts to move inventory. Paying exorbitant commissions while offering discounted prices is unsustainable. In terms of cash flow, NIO reported cash and cash equivalents of 41.9 billion RMB, approximately $5.7 billion. However, this amount includes cash equivalents, meaning that the company's actual liquid cash is significantly lower. Given NIO's current burn rate, the company has roughly 12 months of operational runway before it requires additional financing or must achieve profitability. This is why management is aggressively targeting profitability by Q4 2024. Despite these challenges, there are reasons for optimism. NIO is launching its new 5566 models soon, which will feature the NX931 chip. This innovation is expected to boost vehicle profits by approximately 10K RMB per unit. Additionally, newer vehicle models are likely to have higher average selling prices, especially as the company moves away from inventory clearance discounts. Better margins are anticipated with upcoming releases, such as the 777, 787, and 8 series models, which will feature a 900-volt platform. These advancements should contribute positively to NIO's profitability. Nevertheless, SG&A costs remain a critical issue. The company acknowledges this problem and is actively working to address it. Management has indicated that the effects of cost-cutting measures will become evident in Q2. However, Q1 results are expected to be weaker than Q4, with further margin declines. Investors should brace for disappointing numbers in the next quarterly report. By Q2, however, substantial improvements in margin, cost of sales, and SG&A expenses should become apparent. A potential strategy to reduce SG&A costs involves consolidating NIO and ONVO dealerships. However, NIO's CEO has dismissed this idea, opting to maintain separate retail spaces. If this remains the case, the company must focus on maximizing efficiency and minimizing store-related expenses. NIO's current expenditure on store leases and operational costs is excessive. Additionally, Firefly vehicles will be sold through NIO stores, but many investors believe they should also be available in ONVO outlets. With over 400 ONVO stores currently displaying only one car model, this setup is far from ideal. Expanding Firefly's availability to ONVO dealerships could enhance brand exposure and sales. Another concern is the way vehicles are showcased in stores. Many locations display identical models with minor variations, such as different drivetrain options or rim designs. To enhance customer experience, NIO should exhibit fully equipped vehicles featuring accessories like built-in fridges and extendable tables. These features add significant value, particularly for family-oriented buyers. Displaying fully loaded models would make the cars more appealing and showcase their unique selling points effectively. While sales reps will require time to adjust and optimize their selling strategies, time is running out. NIO has only 12 months of financial runway, and management must act swiftly to implement meaningful changes. However, there is no sense of panic at the executive level. This confidence likely stems from NIO's access to various financial resources. As a prominent Chinese EV brand, NIO is unlikely to face bankruptcy. The Chinese government considers NIO a key industry player and may intervene if necessary. Historically, NIO has received government-backed financial assistance, such as the 2019 Hefei investment deal. Similar support could materialize again if needed. For investors, any sharp decline in stock price due to panic selling might present a buying opportunity. While not financial advice, the presence of a government-backed safety net provides a level of reassurance for long-term investors. In summary, while NIO faces significant challenges, including unsustainable SG&A costs and a tough Q1 ahead, the company has a clear strategy for improvement. The introduction of new models, improved margins, and targeted cost-cutting measures should lead to a stronger Q2 and a positive outlook for the rest of the year. Investors should prepare for short-term volatility but may see substantial gains as NIO executes its turnaround plan. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.